This is level 3 of the CFA program, the topic on capital market expectations and the reading on framework and macro considerations. This is a relatively long reading, and so we have nearly 50 slides in this slide deck. But I think it's interesting in that in this reading, we're going to build directly upon those two previous readings on behavioral finance, as well as lots of material that we covered back in level 1, in particular, macro and microeconomics and quantitative analysis. This is how I want you to think about this. Even though the reading doesn't obviously and directly emphasize how CME fits into the policy statement, I'll probably emphasize that throughout this recording. So I want you to think about it in this fashion. Suppose that I'm your client and I came to you in, let's say, November of 2019. And you were a perfect financial analyst. In other words, you had the ability to perfectly forecast, perfectly predict COVID and the inflation bubble and everything that's happened over the subsequent 3 years or so. And if I came to you with some of my investable assets, let's say it's $4 or $5 or $10 million, and I said, here, I don't know what to do with it. You figure it out. And you were this perfect analyst, and you knew COVID was coming, and you knew we were going to have this massive inflation, you would probably say, you know what, Jim, I think we should probably not invest in equity securities, probably not even fixed income securities, maybe an alternative investment, maybe private equity, maybe a hedge fund, or maybe we should just buy some gold, or maybe we should just take it up into our attic and bury it in the insulation up there. Of course, that's not a good outlet. But you get my point here, is that these capital market expectations essentially provide the foundation for identifying which asset classes are relevant and which asset classes are timely for the client. And you'll see that as we go through these learning outcome statements. Notice there's a lot of discuss and explain. And by the way, the handful of end of reading questions are really good. I want to make sure that you go and look at those. I think the first 7 or 8 are in a multiple choice framework, and those are relatively straightforward. But then the Institute asks you to discuss and explain, and boy, they hit all of these LOSs. And so I think these are probably equally important. We'll go ahead and talk about capital market expectations in the context of portfolio management, in the context of economic growth, in the context of business cycles, how it impacts inflation. Then we'll go ahead and spend a little bit of time on how the government influences all this business activity with monetary and fiscal policy. And then we'll have kind of a general discussion at the end of the LOS. And so those of you who've been following along with many of our slide decks, we try to start out these longer ones with some type of a brief recap on, kind of what you should know and what you can expect during this particular reading. So this is not the first time you've heard of capital market expectations. So, what do we know from levels 1 and level 2? Setting risk and return parameters, which means as it relates to the policy statement, it relates to the risk objective and the return objective, and how those all of the constraints, including liquidity, fit into the risk and return objectives, which are a function of the risk and return parameters that we have studied level 1 and level 2. So here's a good distinction. Macro expectations are asset allocation. Micro expectations are security selection. We need to make sure that we're consistent both cross-sectionally, which means across asset classes, and intertemporally, which means across time. And in the reading, there is a little bit of an emphasis from the Institute on the difference between a short-term horizon and a long-term horizon. And of course, a client may have different kinds of attitudes between the short and the long term, but the Institute wants to make sure that whatever we do in the short term, it doesn't imply the polar opposite in the long term. All right, so let's take a look at this first LOS. Discuss the role of CME in the portfolio management process. So I probably touched on a couple of these here in my introduction, But I also touched on a handful of these in the 2 behavioral finance recordings that we just put out. All right, key inputs in strategic asset allocation. So let's go back to that example. I'm the client and I come to you with, what did I say, $5 or $10 million. So what do you decide? You decide that, let's go ahead and just come up with something simple. 60% equities, 30% fixed income securities, 5% cash, 5% alternative investments. And you know what I want to say in here? I want to say, let's do 4% alternative investments and 1% derivatives. I'm always in favor of throwing derivatives in there, comma, if of course it fits with the risk return objective of the client. Once again, we can't discuss CMEs without referring back to Harry Markowitz and the efficient frontier. So remember, what we're trying to do is we're trying to use our broad and deep knowledge base to be able to, and you ready for this? We're going to push our clients to the vertical axis. We want to minimize risk, and we're pushing our clients upward on the vertical axis, trying to maximize expected return. Those are kind of mutually exclusive objectives, but this is what we want. No matter what we do, we want to deliver to our clients an efficient portfolio. So here, let me go back here just quickly. Look at risk and return parameters, macro and micro expectations. If we have these consistencies, then we're better able to build an efficient portfolio. There we go. I've already mentioned the orange block, formulating risk and return expectations for broad asset classes. So, of course, what do we know? We know that historically, the S&P 500 index averages, maybe just under 10% of an annual return, and it averages somewhere in the high teens as in terms of a standard deviation. And so I always tell my students just around and say, look, the S&P 500 index, you can expect it to return 10% with a 20% standard deviation. That's kind of a general idea. But what that does then is that gives us, kind of a framework for all of the other different types of equity classes, and then we can switch over to fixed income, we can switch over to alternative investments. And what that does then is that it gets us consistent with what's going on in the entire marketplace, right? Capital market expectations, we're starting at the top. So this is top-down research, and then we're going and lasering in right on the return objectives and the risk objectives for every one of our clients. Now, of course, what did we just learn in those 2 behavioral finance readings? We learned that stock markets in general and asset markets in general are efficient. We might even say that we believe that the markets are semi-strong form efficient, according to Eugene Fama. But what we also know is that there are pockets of inefficiency, and many of those inefficiency pockets are due to the behavioral issues that we have recently described. What that does imply then is there are short-term mispricings. So remember when we looked at the picture of the security market line, those securities that fell under the security market line, they were overvalued. Securities that fell above the security market line, they were undervalued. And so this is, here, just let me go back here real quickly. This intertemporal consistency, what we want to do is make sure that for our client, we have this strategic asset allocation, and it's probably in our best interest and the client's best interest to have a range. What did I say earlier? 60% equities. What we would probably want to do is say, hey, for Jim, let's do 55 to 65% equities. That allows for tactical shifting of asset allocation to take advantage of short-term mispricing if that mispricing is due to behavioral issues or if that mispricing is due to just some type of a non-priced economic input factor. All right, the reading goes through these 7-step frameworks in pretty good detail, and there are probably fairly obvious to you. So we'll specify the expectations needed. So just think about me. I'm Jim. I'm a 61-year-old client. I have $5 million. I don't have $5 million in reality, but let's suppose that I had $5 million and I came to you for advice. And so you would, cover these asset classes and the investment time horizon. You'd ask me questions and you'd say something like, okay, Jim, when do you want to retire? And I would say, well, I still have a handful of children in high school, so I need to get them through college. I need to get them started on their career. So I'm probably going to teach until I pass away. I don't know what that means for an investment time horizon. All right, so we have those expectations that are needed for the individual client. Then we're going to examine the historical record. This is what I was saying earlier about the S&P 500 index, returning on average 10%. So you do this with all of the asset classes. But I'm going to go ahead and put a comma here at the end of this conversation and say, okay, we're going to examine the historical record. That's a really good place to start. But we don't want to base our entire framework of CMEs on the historical record, because even though we know that history repeats itself, and what did we learn back in quantitative methods? We learned about mean reversion, and we do know that all sorts of statistics revert to their mean, but of course the issue is timing. When is inflation in 2022, which is 8 or 9%? When is that going to revert to its long-term mean? We know it's going to fall, but it might be until after I'm 6 feet under. Maybe that's 20 years from now, so that probably doesn't do us any good right now. All right, specify methods and models. So what have we done? In level 1 and 2, we talked about lots and lots of models. We did the capital asset pricing model. We did the Harry Markowitz efficient frontier. We did Stephen Ross APT. In fixed income securities, we did Cox, Ingersoll Ross. We did all sorts of models, so we need to figure out which are the most appropriate models and methods to use. And look at the very last sentence there. I think this is a key phrase in terms of potential exam questions: to ensure consistency. We're going to use different kinds of models. We want to make certain that those models are consistent so that the output then makes sense. Best sources of information, of course, in my academic training, we learned this when we were doing research papers for classes and writing our dissertations. And so we need to make certain that we have best sources of information. Here I'm not advertising anything. I'll just tell you what we have at school. Those of you who pay attention to my recordings will know that we have the Morningstar software, and we have Bloomberg in our trading lab. And so those are probably pretty good sources of information. Reliable, I think that's probably a key word that the Institute would use on an exam. Oh boy, look at the red one here. Interpret current environment. So this is what we're being taught, level 1, level 2, and level 3, to be able to process all of this information. And remember, Eugene Fama and Harry Markowitz and William Sharp, they all relied on this concept of a rational investor. And a rational investor is able to interpret current information accurately and responsibly and prudently, and all of those good words. And so notice what we have written down in there: deliver a common set of assumptions with consistent methodology. That makes perfect sense. Then you've made these decisions. And you know as well as I do, maybe even better than I do, that you're going to make a decision and it's not going to be perfect. And so you want to learn from your decisions. And this is what I tell my students all the time, that I create my own exams for every one of my classes. And so they're not perfect exam questions, but I design them specifically so that they are learning experiences. So the student, after taking my tests, say something like, you know what, I learned something. I'm better prepared to take the next test. Oh, I wish I could take this test over again. And that's why I emphasize so many times in these recordings to go look at the end of reading questions that the Institute provides, and then go look at our questions. We do lots and lots of research, and we work really hard in quality control and putting these mock exams out. So this is kind of a practice test. So then you know where you have your weaknesses and your strengths. And well, that's pretty much what we're doing here with monitoring actual outcomes. All right, moving on to challenges in developing capital market forecasts. You can just imagine from a common sense standpoint, what these challenges are is that, boy, what we're trying to do is we're trying to estimate, forecast, predict the future. So the challenges in developing capital market forecasts probably have a lot to do with that uncertainty. And then what the Institute is looking for in terms of this particular LOS are specific challenges in those areas of uncertainty. And so, let's go ahead and go through these quickly here. Limitations of using economic data. What do we know? That the data is based on history, so there's probably some kind of a lag between when we collect the data and when the data gets publicly announced or publicly available. Varying definitions of data in different countries. I like this one. In 2022, I'm guessing a lot of people, not just us, but a lot of people learned the definition of inflation, at least as the way it's computed here in the United States. And inflation is computed different ways in different countries there. Different ways that the indexes are calculated. Remember back in level 1, we talked about the price-weighted index with the Dow Jones, the value-weighted index with the S&P 500. And so, you have these indices that may or may not be based on something that's similar or something that's different, and there's rebasing processes there. Changes in index composition. Those of you who are regular readers of the Wall Street Journal will know that the S&P 500 index changes its composition, pretty regularly, and they make an announcement. How about some human errors, right? Transcription errors. You could put in a 10% inflation rate instead of the actual 1%. Boy, think about how that would bias any kind of an output that you have. And then there's one of these biases that we learned back in our quantitative methods days, survivorship bias. And this happens all the time when you have some type of a variable that drops out of the sample because it no longer exists. And some people might say, well, if it doesn't exist, then it doesn't belong in the sample, and that makes perfect sense. But you have to ask yourself the question, okay, why doesn't it exist? And if it's because that particular variable really was a bad variable, or it changed, or it was a poor variable, then it probably needs to be removed from the data. But there's this survivorship bias. This is especially true in the alternative investment market. I mean, look, if you want daily stock prices for a company like Walmart, you can get it today, you can get it yesterday, you can go back, thousands of years. Whenever Sam Walton started his company, you can even get data for every trade. But if you want to get data on, let's say, some type of a collectible item, like how about a bottle of wine that was vintaged in France in 1300. Boy, how are you going to get data on that every day or every minute? So you use appraisals, and so those probably are not going to be as accurate as you would want them to be. Historical estimates, of course, what did I say earlier? These are good starting points, but they can't be the ending point. So we need to go back when we look at historical data, see what the problems are. And so the reading emphasizes these regime changes that are very likely to lead to non-stationary data. I remember my econometrics professor in graduate school gave us an assignment one day. He said, this is what I want you to do. I want you to go and estimate the beta for this particular company, I forget what it was, over this time period. And then I want you to estimate the beta for that same company over this time period. So we went off and, got out our computers and we did that. And one beta was like 0.8 and the other beta was 1.2. And we came back and he was like, okay, which one do you use? Now you understand why data, the non-stationarity component of it, which could be due to economic, political, regulatory, or technological changes. Stationary data is a huge assumption, and it's probably violated all the time. That's why when I wrote my dissertation, I collected data, daily stock returns for 3 years. So that's why I say long period of time. But the problem is you may not have the available data for all of the components of the sample. And there are other problems in there: high frequency data, more possible regime changes. So note the limits of historical estimates. Using ex post risk and return. And so we surely don't want to say something like, oh, that stock generated 12% return last year and 12% the year before and 12% the year before. Therefore, it's going to generate 12% this year. What did I say earlier? The past always repeats itself, but we don't have any idea about the timing and the magnitude of that repetition. Now, here's a problem for all of the technical analysts out there: is that there might be repeating data patterns, but there might be non-repeating data patterns, which will lead the analyst to make these false relationships. Failing to account for conditioning. Yeah, boy, of course, this is why I tell students to read the Wall Street Journal every day, so you know exactly what inflation is in its most current level, so that you can incorporate those things into the models. Misinterpret of correlations. We've talked about what's that called? Spurious. So you don't really want to make certain that you decide that just because there's a high correlation that there's also causation in there. So just make certain that you're aware of that. Here's the link between what we're doing inside of this reading and what we've done on the last two readings. So I'm hoping that you paid very keen attention to my two recordings on behavioral finance, so that you know about these cognitive biases, you know about these emotional biases as well. And so in this reading, the authors call these psychological traps. And these are pretty obvious notions from our previous readings. How about model or input uncertainty? Of course, what you could do is say something like, hey, I'm going to go ahead and collect the number of parking spaces available outside of the hospital every day, and I'm going to use that number to estimate inflation in the healthcare industry. Oh man, there's probably no relationship between those two. Maybe some minor relationship. If nobody's going to a hospital, then they're probably not making any money, et cetera, et cetera. So model uncertainty, parameter uncertainty, input uncertainty. All right, how about this concept of exogenous shocks and how these shocks may impact growth trends? And I was interested in this particular part of the reading because what the authors do is they clearly state that these exogenous shocks can have potentially positive or negative effects. Yet they have a pretty positive attitude about this. And so the emphasis inside of the reading is really on the positive nature of these shocks, how these policies can have a positive impact on growth. So let's take a look at these, just quickly. So sound fiscal policy. I'm going to go ahead and take off my instructor's hat and just put on my regular old taxpayer's hat. I have no idea what a sound fiscal policy looks like, because here in the United States, I'm not sure that we've had one. I'll just go ahead and throw out a number. 2022, we have $31 trillion worth of outstanding Treasury securities. So let's go ahead and try to identify this. A sound fiscal policy will be a policy in which the tax revenues look an awful lot like the government spending. We want to, I guess sound fiscal policy, pushes us towards some kind of a balanced budget. So that's probably what I would look for on the exam. Minimal intrusion from the private sector, lots of competition. Sound tax policy. Let me go ahead and throw my hat off again. Not sure what a sound tax policy looks like, but I'm fascinated by the reading. Of course, the readings don't ever get political. They don't ever give you, which side of the political spectrum that you should be on. But they do mention something here. They say, oh boy, in 2017, and I won't go ahead and mention the president in 2017, but the reading specifically says, the reduction in the corporate tax rate from, whatever it used to be, let's say 35% down to 21%, that was a pro-growth policy. And the very next sentence, they say something like, boy, the restraint on trade, the tariffs and the quotas and all that stuff probably reduced growth. So a sound tax policy somewhere and a sound fiscal policy are kind of like ideal scenarios. Wasn't there a great economist who said something like, I'm in favor of lowering tax rates at any time for any group of people for any reason? Yeah, and there's that last teardrop point, erecting trade barriers has a negative impact on growth. So it's really kind of fascinating to see, the 2017, we have reduction in corporate tax rate, but yet we have these trade barriers, so it's our job, these exogenous shocks, it's our job to say, okay, do they even each other out? Will they cancel each other so there will be no impact on growth when you consider the net effect of those? Now, I don't know if the Institute would get that level of granularity on the exam. I'm guessing that somewhere in the question stem and in the fact pattern, they would write something about, hey, we're going to erect trade barriers. And then a question will be something like, hey, explain how that trade barrier will impact growth. And you would write something like, negative impact, and then you would give the whole economic reasoning. All right, new products and technology. Of course, this makes perfect sense. So these are pro-growth factors. Geopolitics, yes, tensions. But what those tensions might do is that they might, and here's where the Institute is trying to find the the kind of silver lining in this, lead to development of new technology and encourage innovation, but trade barriers against defense spending. Using resources to acquire weapons. So I'm guessing here that there's a relationship between developed countries that are, let's say, military powers, and their trade relationship with emerging markets and younger military that that might have a need to defend itself. Natural disasters, of course, in the short term. And the reading does emphasize this. So I want to go back to, I'm not going to flip back to that earlier slide, but remember I was telling you about difference between short and long term. But clearly these natural disasters, reduce short-term growth rates. But here's the silver lining again. If, think about this, if a hurricane comes in and wipes out a sewer system that was built in the 1950s. So this sewer system was, let's say, inefficient. It was going to, maybe cause sicknesses and maybe do all sorts of bad things. And so it gets wiped out. So it's replaced with a much better and much more efficient asset. And so it may enhance growth. So demolition of old capital. Natural resource discovery. Once again, the Institute doesn't, provide a political spectrum opinion here, but they do mention the concept of fracking. When we decided, and I don't know anything about science, but I do know that fracking, we were allowed to go like this, and then like this, and then like this, and then like that, whatever that means. And then we pump water down in there, and all of a sudden we can get way more natural gas out of the earth. All right, so natural resource discovery tends to promote growth, but then the depletion of resources. And one of the tables inside of the reading lists as a potential asset class as New Zealand forestry. So I'm thinking about the timberland is mentioned multiple times in some of these readings. And so I'm guessing that it probably would show up. So think about this. If you get this vignette in somewhere in the question stem and in the fact pattern, there's probably going to be a question that says something like, okay, we're chopping down these trees for growth because we have all these buildings over here to build. That's a good thing, but we need to replace those trees. And so we ask ourselves the question, what does that company do to replace? So you chop down a tree and then you plant 5 or 10 or however many it works. Financial crises, just think back to 2008, lose faith in the intermediaries. I'm not sure that the faith has been entirely restored in the decade or so since we've had that crisis. Runs on banks, stock market crashes. Boy, do I need to say this? Are we getting used to stock market crashes? I hope not. All right, how about application of economic growth trend analysis? So let's go back to level 2. Remember, we did time series, and we had all of those really cool models on time series, and we were asking ourselves the question, will that time series, that historical time series, will that extend to our ability to predict future growth rates, future economic growth rates, and then, of course, ultimately, future asset values? And so what I want to call your attention on the right side of the screen, look at the difference between the developed countries and the emerging economies. And so what do we know? Higher trend growth rates imply higher yields on government bonds. All right, that makes sense, that if we have lots of growth, that in order for us to lend our money to the government, we're probably going to demand a higher return because we have all these other outlets out here. So that's a little bit of an opportunity cost embedded in that first one there. What else did we learn in level 1 and level 2? We learned about the discounted cash flow model. So think about our free cash flow to equity, our free cash flow to the firm. Even think about the simple Myron-Gordon dividend discount model. So there's a growth rate in there. Remember when we did Myron-Gordon, that was a function of profitability. Remember that return on equity and our earnings retention rate. So that's at the micro level, at the individual corporations. But let's go ahead and expand that, to the entire market. So let's think about growth rates in companies. Well, what does that mean? That means that this growth rate that we're trying to forecast based on all of our capital expectations are going to be a critical input into those discounted cash flow models. And so, of course, just using the simple Myron-Gordon growth model, if you have a higher growth rate, that implies that we're going to have higher stock prices and then therefore higher capital gains. Now, the consequence there between short-term and long-term is that, boy, if we've got lots and lots, think about the economy. If it's growing like this super fast, what does that mean? That means that individuals inside of the economy, they probably have higher incomes, so they're probably going to go out and spend more money. So we need to worry about, does that translate into higher levels of inflation? Let's decompose growth from labor and growth from labor productivity. This is probably a review of what all the hard work we did back in level 1. So growth in labor. So first of all, we have labor size. Didn't I just read recently that we've had we're nearing our 8 billionth birth, or the next birth will be the 8 billionth person. Maybe my granddaughter will be the 8 billionth person if we can hold off until another month or so. And then the other part of that is the growth in the actual labor force participation. So this is really important because just think back to COVID. What did we have? So we had lots of people who weren't working, and then the federal government came in and said, you know what, you're not working. We'll go ahead and give you some kind of a replacement income. And then what did we find? We found that people, they liked staying home and getting that replacement income. And so the labor force participation rate has dropped. So make sure you know this growth from labor, distinguish between, just the regular old unemployment rate and then the labor force participation rate. And then notice that that's probably going to be a function of real wages. So make sure you remember that for the exam. And then growth from labor productivity. So we have from these increasing capital inputs. And so that could be the result of multiple factors, but maybe we'll just use this term back from level 1. I believe it was capital deepening. And so, that just means, some kind of an improvement in output based on capital inputs. And then total factor productivity. This is probably another way of saying something like, we're becoming more and more efficient. We have more and more technology. I mean, just think of it. You pick up your phone, you hit a bunch of buttons, and then you can take a nap because you've done a hard day's worth of work. All right, how about asset returns? So we've hinted about this just a little bit. So bond yields over the long term. What do we know? We know that they're mean reverting. We talked about that recently, but what do we also know? We also know that they tend to move towards their real their real growth rate in the long term. So you have mean reversion and then trending growth rates over time. So it's up to us as good financial analysts to determine the net impact of those two, orange and red bullet points. Yeah, trend rate, the trend growth rate acts as the anchor for long-run equity appreciation. Here's kind of some simple equation here in the blue box. So let's look at the total market value of equity. And let's go ahead and start with GDP. And then let's go ahead and multiply it by what the reading uses as S raised to the K. And that's just some kind of earnings ratio. And what that is, it's total earnings over GDP. So here in the first part of the equation, you have GDP in the numerator and then a GDP in the denominator. It's kind of like that DuPont model that we did back in level 1. And then we're going to multiply that by a price earnings ratio, an aggregate price earnings ratio, so you have aggregate earnings in the denominator. So think about it. You have GDP in the numerator, GDP in the denominator, aggregate earnings in the numerator, aggregate earnings in the denominator. And so you're saying value is equal to price. So, that's really what we're doing here. But the cool thing about this is that we're breaking it into its components. So what is the total market value of equity in a stock market? Well, it's based on the economy, right? And this is what I tell my students all the time, that when you invest in a well-diversified portfolio, you're betting on an economic expansion, because inside of that economic expansion, there are going to be areas of positive net present values. And so what you want to do is you want to have an investment in those firms that are more positioned to grab the higher percentage of that positive net present value projects that are out there. So you're investing in the economy. So that's the first part. Then you get rewarded for those companies that have lots of profitability. So, there's profitability in that S raised to the K. So you have the economy, then you have profitability, and then you have stuff that goes on the floor of the New York Stock Exchange with price earnings ratio. These are investors who are you ready for this? They are processing economic information, GDP. They are processing profitability information, which is, earnings. And then they go and they meet on the floor of the New York Stock Exchange and they decide how much a dollar of earnings is worth for each individual corporation. So, this aggregate market value of equity equation is not going to win a Nobel Prize in economics, but it's really fascinating and informative and even instructive to give us a sense of compartmentalizing what it looks like from these CMEs, right? These capital market expectations are based on these three factors here. And so here's a slide that pretty much summarizes what I've just been saying. All right, let's go ahead and compare major approaches to economic forecasting. So we have a handful of these approaches. So we've done this before, econometric modeling. So what are we trying to do? We're trying to come up with a statistical method or a statistical model that tests from some kind of a mathematical fundamental relationship the relationships between and among economic variables. So you can have just a really simple model from the capital asset pricing model, which is pretty simple, to, think about an analysis of variance model that has 10 different inputs. And we're trying to figure out what is the relationship between and among the standard deviation of all of those variables so that we can use the output to come up with better inputs. So notice what we have there in the second paragraph. Hundreds of formulas. So what are some examples? These. You don't need me to read that. Economic variables, interest rates, oil prices, exchange rates, inflation. Structural models are based on economic theory. I'll give you the structural model that pops into my mind as is the Fisher-Black model. Remember the Black-Scholes Merton option pricing model, where they used option pricing to structurally price the right-hand side of the balance sheet. They use it to price the bonds, and they use it to price the equity, which is viewed as a call option on the assets of the firm. Those are structural models based on economic theory. Reduced form models are based entirely on a reduced structural model. Sometimes they're called non-structural models. And what you do is you take a look at data and you say, oh, it makes sense, and let's go ahead and take a shortcut. That's what heuristic means. And let's try to figure out the functional form of this relationship. And the reading even does offer, some kind of a slight opinion. And the academics and professionals, they tend to agree structural models are probably superior. All right, what are the strengths of these? Boy, you can collect the data. You can collect some math, right, as an input, and then you can have some output in math. But you can use quantitative collection. You can do the 0-1, right? We had how about a probit model? Did we ever do that in the CFA program? A probit model, in which you have 0 or 1 as the dependent variable, or you can have it as an independent variable in regular old regression. So the models, they're probably robust, and the reason that they can be robust is that you can use different models to test the same kinds of relationships between and among variables, and then you get the same output. So you can test for robustness. Robustness, is that a word? Robustivity? Well, whatever the word is. The model process imposes discipline and consistency. I guess that's true, and the reading says it's true, so it must be true. I just go back to my graduate days when there were 3 or 4 of us writing our dissertation together, and boy, I guess the model imposed discipline and consistency on us, but sometimes it didn't. All right, what are some weaknesses? Well, the weaknesses are that in general, it's difficult to capture all of the relationships. Go back to the capital asset pricing model, where the beta, this little slope coefficient, is supposed to capture all of the relationships between and among the individual company and all of these economic variables. That's a lot of weight to put on this little old beta. So complex, time-consuming, et cetera, et cetera. Data may not be easy to collect. It may not be easy to interpret. It may not be easy to forecast. Yeah, relationships, they're dynamic and they're probably not static. Misspecification. This is an important one. My econometrics professor would always say to us when we came to him with a model, and he was actually on my dissertation committee, and part of my dissertation was to look at poison pills and to see what was the relationship between poison pills and stock returns. And he cautioned me when I did a regression analysis and said, "Are you sure that model is correctly specified?" And of course, I gave him the regular old doctoral student answer. I was like, "Well, I think it is, but you tell me why it's not." And then we fixed it. All right, how about economic indicators? We learned all about this back in level 1. So there are lagging indicators, there are coincident indicators, there are leading indicators, and then there's this broad perspective, diffusion index, in which we, throw a bunch of these indicators in at one time. And so the diffusion index is probably designed to identify the weakness in the lagging indicators, which means, we're looking at the past and we're saying, okay, that happened. Is it going to happen again? Is it the time? How about the coincident indicators? So these things move with the business cycle, and then leading indicators. And so if you read the Wall Street Journal regularly, you'll note that those journalists, they try to report on those leading indicators with more emphasis than the other indicators. Intuitive and simple, that makes sense. The primary focus is identifying the turning points in the business cycle. And we have a slide here in just a few moments about the business cycle, but I'm guessing you remember this, the business cycle goes like that. Weaknesses, frequent revision. Of course, we're continuously updating our Bayesian probabilities so that we know that if we have monthly data on inflation, we probably ought to incorporate that. How about checklists? Wide range of economic data. So what we do is we list all of these things, and we might try to list them over time period, and we say, okay, this is going up, this one's going down, and we're going to try to use our vast knowledge and wisdom that we've learned from the Institute to identify some kind of a forecast for growth. So it's not very complex. It's very flexible, and you can throw almost any topic in there. However, it's subjective, and so that's probably its weakness. It's probably time consuming to gather all of this data and to try to figure out what it means. Look at the last one down there. Could be biased because, of course, what did we learn? We learned that it's not just other people that that make cognitive errors and have emotional biases. We do the same thing as well. All right, how about a conversation on business cycles? And so here, let me show you this. Here's our picture of the business cycle. So we have the peak, we have the recession, we have the trough, we have the expansion, we have recovery. So there's time on there. Boy, wouldn't it be awesome if you could get in a time machine and you could see what this looks like for the next business cycle? Boy, you wouldn't need me to tell you how to make tons and tons of money. I'm hoping that you would come back from the future and you would ignore the stock market, ignore the bond market, and go right to the derivatives market. In particular, go right to the swap market and enter a swap with a $1 trillion notional principal, and you'll be a billionaire in maybe a week's time. All right, so getting back to the LOS. So how business cycles affect short and long-term expectations for growth. All right, so what do we know? We need to know, and let me go back here real quickly. We need to know where we are in this business cycle so that we can identify these short-term trends around that long-term expected rate of growth. And knowledge of the business cycle then gives us that ability to manage the difference between, here, let me go back. Whoops, let me do it here. Let's suppose we're at the trough down here and we're doing the expansion, so what are we trying to do? We're trying to identify undervalued stocks in that expansion. So we overweight those high growth stocks in our tactical asset allocation, knowing full well that we're going to revert to the mean at some long-term growth rate. And so what we're trying to make certain is that we measure short-term changes around long-term expectations, and that's what the business cycle does for us. So what do we have in those 2 bullet points here? I think these are important. The economy cannot grow any faster than its long-term trend rate in a sustainable mean. That of course means that it's mean reverting. Movements around the trend rate are ultimately stochastic. That means that's a fancy calculus term for meaning that there are random, or at least relatively random. Stochastic implies continuous time finance, so all that stuff that we learned back in level 2. Business cycle phases vary in terms of intensity and length. So once again, there's the sensitivity that we have to have between short and long term. And so the reading then does emphasize this concept of an output gap, where we take actual output and we subtract the maximum potential output, and that gives us an output gap. And that gives us a really good sense of the relationship between short and long term. All right, so go ahead and get your phone out. Take a picture of this thing if you don't already have it memorized from previous recordings, because you'll need to know peaks, recessions, and all those different places. So let's go ahead and just quickly remind ourselves about these different points along the business cycle, and let's try to relate them to short and long-term expectations. All right, so let's go back here real quick. So we're starting with the trough, right? So the initial recovery could last just a few months, and I'm going to go ahead and put a comma there. This is kind of an average of what this business cycle looks like over time, but there's nothing guaranteeing that initial recoveries are going to last for just a few months. All you need to do is go back to the stock market crash of 1929. I mean, gosh, that's almost 100 years ago. God, hard to believe that, right? The recession and the depression, they lasted for a decade or so, right? All right, but the reading does suggest that this lasts for a few months. So I would remember that for the exam, but don't be married to a few months. All right, the economy starts picking up, right? What happens? What did I say just a few moments ago? Firms start finding positive net present value projects. So that means that maybe they start hiring one or two or a few more workers. We have a large negative output gap. We have inflation that is probably decelerating. All right, so look for fall in prices, low interest rates. But then we're probably going to say, you know what? Here, we've got positivity on the horizon. Let's go ahead and build that house out there. All right, so early expansion, this thing can last for a few months, maybe a year, maybe to several years. You know, we've had this several times during my lifetime. The economy gains momentum, unemployment rate starts to fall. The output gap remains negative, however, but there's probably going to be a rapid rise in profits. So strong demand for housing, so interest rates are rising, that means bond yields are rising, and it probably means stock prices are rising in early expansion. Most likely those rising stock prices are the result of companies finding positive net present value projects, which means that the GDP is starting to grow, right? All right, how about late expansion? So there's another time frame there. Output gap is closed, no doubt about it. That's probably the key there, that output gap is closed. So this is going to tell us that we're, let me just go back here quickly. Let me do one more. This is going to tell us that we're late expansion, that we're probably nearing the peak, right? Boom mentality is in the air. So let's go ahead and knock ourselves on the head and say, okay, are we getting ready to hit a bubble? All right, unemployment is low, profits are strong, rising wages, so more people have higher incomes, so that's probably going to lead to inflation, which of course leads to increasing bond yields. But now we probably still have rising stock prices because the economy is growing, but we're going to hit that point where volatility is probably going to rise. Look at the bottom there. Central bank cuts the growth of money supply. Don't look at the history of the U.S. central bank to give you any kind of a notion about that. But clearly that's what the reading says. So make sure you remember late expansion, the central bank will very likely cut the growth of money supply. All right, how about we slowing down? Because we have lots of inflation, and so that must mean that interest rates are rising, and so there's probably going to be fewer people that are borrowing money to build houses and to buy equipment for corporations. Look, fewer viable investment projects. That means that there are few positive net present value projects. And then we get into the possibility that if firms, here, think about this, late expansion, if firms have lots and lots of free cash flow, once they get into a slowing down economy, they might be tempted to invest in negative net present value projects, probably accumulating a debt which is accompanying with higher interest rates. The economy is vulnerable to a shock. So what did I say back over on that left-hand column? The boom mentality, are we ready for some kind of a bubble? Well, vulnerability due to a shock, maybe you could call that to a bubble, which will result in crashing stock prices. And then we have a contraction, usually lasts 12 to 18 months. Let's go ahead and go with that, but that could be almost any number. Rise in unemployment, easing monetary policy. Well, that's true, right? The government seems to ease monetary policy no matter what. Clearly, it does it under contractions. Sharp drop in profits, bankruptcies, unemployment, credit tightens, all those good things. Now, let's go ahead and ask the important question, the important follow-up question. So think about the fact pattern, which will, here, let me go back here. So the fact pattern will give you some, let me just go through these here. We'll give you some of these points. And so you need to say, now it's not going to say, I wouldn't think that the Institute would say, okay, we're in the early expansion time period. Tell me what that means. They're going to, seems to me like the better question is to give you, these kinds of fact patterns that you will have to conclude in the early expansion. And then what you'll be able to do is say something like, okay, how does this impact our market expectations, right? Now look at the first teardrop point. Seems straightforward under those previous descriptions, but then go ahead and look down at the third one. The truth is quite a bit more complex than that. All right, so what you're going to be ready for on the exam is this straightforward interpretation, but then look for a question that says something like, boy, you're probably not going to be right. How about something like that? All right, how about these implications of inflation? And this is clearly not intended by the Institute, but it's a timely manner in 2022 where we have tons and tons of inflation. So what I'm going to have you do is get out your phone, take a picture of this slide again. In particular, the little illustration that we have put for you over on that right-hand side. And so if you can just memorize these things, inflation is declining, it's low inflation, just work your way through the initial recovery all the way to a contraction, I think you'll be able to answer those exam questions. So let's go ahead and focus then on the left-hand side, which is some of the reasons why we have those results over on the right-hand side. All right, so what do we know about inflation? It's just clearly the difference in price levels. And so it accelerates late in the business cycle when there is no output gap. So that's probably super important. Deceleration of the rate of inflation. We call this disinflation. Sometimes we call it zero inflation. Sometimes we call it, boy, how is it possible that prices are falling? But when you have these prices are falling, that's probably when we're going to have a downward sloping yield curve, right? And that is most likely because of massive reductions in inflation. So that probably is going to move us into a higher likelihood of recession. That second embedded point, probably another good exam question. All right, how about the relationship between inflation and the different asset classes? And so if we're having cash, if we're holding cash, and let's just think about it in a money market index fund, what we're concerned about is the real rate of interest, not really the interest rate, the nominal rate that we get on this, but the real rate of interest. And so our real returns are going to depend on whether that expected inflation exceeds or is lower than our actual nominal cash yield. And what do we know about bonds? We learned this back in level 1 that among the components of the yield to maturity on a bond is a component for the inflation premium. So when inflation goes up, that means that interest rates, yields go up, and that must mean that bond prices go down. There's that first sentence there. Inverse relationship. Also remember that short-term bond yields are way more volatile. The 30-year bond yield, when inflation goes from, what did it do in 2022? It went from 8.1% annualized to 8.2% annualized. Well, those short-term bond yields, they became super volatile. But the 30-year bond yield, it pretty much yawned in relation to that. Although in 2022, we did have an inverted yield curve. And it's because of this relationship that we're talking about. So look at the bottom paragraph there. Disinflation or deflation is probably favorable for fixed income securities because interest rates are falling, which means bond prices are rising. All right, how about the relationship between inflation and equities? And so this is what I learned from my graduate professors long time ago, is that you have profitability on the corporate side and you have inflation on the macroeconomic side. And when inflation is increasing, that's probably not a good thing, depending on the stage of the business cycle and the difference between current inflation and expectations for future inflation. But, when we have rises in inflation, that's probably not good. However, if corporate incomes, if net income, earnings from businesses is growing faster than inflation, then stock prices are probably still going to rise. This was a valuable lesson I learned from my professor long time ago, and it's probably true in almost all cases, and that's pretty much what the Institute is trying to tell us here in that left-hand column. right? So some firms can pass on higher costs to consumers, some can't, right? Deflation has a negative effect on equities due to the decline in economic activity, and that goes back to that market value simple equation that we had a few slides ago. How about real estate? And so you think about this, real estate has lots of leverage. So if inflation is rising, that means interest rates are rising. That probably means that the debt service costs of real estate owners is probably rising. However, it is relatively easy. Now, of course, I'm forgetting about COVID here, but it is relatively easy for real estate owners to increase their rents with inflation. So if you think about this, when you have inflation in the economy, it's probably going to be reflected in rising rental property income. And so that's why the Institute emphasizes that middle one. Real estate value increases in line with inflation in the long term because it acts as an inflation hedge. How about the LOS on monetary and fiscal policy on business cycles? So we're asking the question, how can governments impact not only the business cycle, but how can they impact growth rates? All right, so let's go ahead and start with monetary policy. What do we know? Central banks are in control of the money supply. And so what central banks can do is intervene in the business cycle to probably change an undesired outcome inside of that growth rate in the money supply, right? So monetary policy is almost always counter-cyclical. All right, so they use monetary policy to either prevent the economy from overheating, or overheating meaning the inflation and going to that peak, right? Getting too quickly to that peak, or going past that peak, or suffering from a recession for too long. One of the interesting things about 2022 is that the U.S. Central Bank is doing everything that it can to prevent, at least that's what it's saying, to prevent a recession. So look at that. What is that? The fourth arrow point there. The aim is to maintain growth around its long-term sustainable rate, as long as that growth rate exceeds the increase in inflation. Restrictive monetary policies, on the other hand, are employed toward the end of an expansion because of over-tightening may lead to a recession. And this is what politicians are saying in 2022, that, we don't want the Fed to raise interest rates because that's going to push us into a recession. However, they're forgetting the underlying economic factors that lead to a natural increase in interest rates. All right, how about when the Fed does reduce short-term interest rates, like the discount rate or the Fed funds rate? So what that tends to do is increase consumer and business spending, probably increases equity and fixed income security prices. Now remember with those fixed income prices that there's this inverse relationship between yields and prices, and it depends on the duration of the bond. And the Fed policy of reducing short-term interest rates is probably going to lower the value of the domestic currency. We'll go ahead and talk about that in just a few slides. But remember that it also is probably going to increase exports. When inflation is too high, central bank will increase short-term rates. If the economic growth is too low, the central bank decreases interest rates. All right, so those two arrows down there on the bottom are probably good ones to memorize for the exam. All right, so given what we've discussed about growth rates and monetary and fiscal policy, what we need to do is we need to come up, with some kind of a guide. And so this is the Taylor rule, sometimes called the Taylor principle. And it was developed, decades ago to guide central banks to set an interest rate. So look at the blue box there. We've got the interest rate. This is the target and short-term interest rate. Maybe it's the Fed funds rate. And what's that going to be a function of? It's a function of, some kind of a neutral, real short-term interest rate, right? So what does that mean? The real part of it just takes out inflation, right? So this is a measure of how much better off investors are from one period to the next in relation to their total return during that time period. All right, so then notice we have the little symbol for pi, and that's the expected inflation rate, not the historical inflation rate, but the expected inflation rate. So where do we get that? Well, we get a bunch of economists together and we say, hey, what do you think prices are going to be a year from now? And then we probably take an average of that, so that's the expectations of the rate of inflation over this time period. And then notice what we're going to do. We're going to equally weight, there's the 0.5 plus the 0.5. We're going to equally weight the difference between the expected GDP growth rate and the long-term GDP trended growth rate. There's that first part. And then we're going to take 50% of the expected inflation rate versus the target inflation rate. And so notice what this Taylor rule does. It gives us a target rate that's based on, some measure of neutrality, some measure of expected inflation, and then the difference between what's happening in the economy and the difference between what's happening with inflation. So that's why we have the trend there, the y sub trend, and the pi sub target. And so the LOS doesn't ask us to use the Taylor rule. It doesn't ask us to compute it or to demonstrate it. It just asks us to discuss. And so if you get to this essay kind of a question, just remember that the Taylor rule is a guide for central banks to set short-term rates, and it's a function of expectations for inflation. And the difference between that expectation and what we hope inflation to be, right, target inflation rate, we might say something like, we can live with a 2% rate of inflation. And the difference between what that expected growth rate is in the economy and what that long-term trend is. So this is kind of a summation of what we've been talking about over the last, 20 slides or so. Target rate should be set by the central bank. Of course, these are really, really smart men and women who should be able to figure out what that target rate is. What this does, notice the third teardrop point, it balances the risks of inflation, right, an overheating economy, and the risks of recession and an underheated economy. How about a cold economy? Now, the reading does spend a few moments talking about zero or negative interest rates. And, I'll repeat this again. The Institute is very big on not reflecting current events. However, it's very big on using history and what those historical rates are and how they relate to what's happening in the future. So there's a whole section on zero or negative interest rates. I'm guessing for those of you who are, how old are you guys, 28 or 32 years old, you've pretty much had very low inflation and zero interest rates during your lifetime. Now, there have been spikes in interest rates to, let's say 3 or 4%. During your lifetime, but essentially you haven't had to worry about inflation until 2022, and you really hadn't had to worry about high interest rates since going back to probably the mid 1990s, right? So look at a couple of these implications. Look for these in the fact pattern. So go back before the financial crisis of 2008. Central banks and investors in general thought that using negative interest rates to stimulate the economy would probably not work. However, this kind of attitude has changed because lots of countries have zero and negative interest rates, and they also have negative real interest rates. All right, yeah, so let's go ahead and try to figure out what this means. What does a negative interest rate mean? It means that if you deposit $100 today, that a year from now you'll get back $98 or $95. And so a negative rate is a net payment made to invest in short-term instruments. Think about it this way. that if you don't have anything else to do with your $100, right, there are no positive net present value projects to invest in. You don't want to buy another television set. You don't need a new car, right? So what do? You put it in a bank, and you put $100 in the bank, and the bank says, we'll charge you 2% to keep your money. And you say, okay. So at the end of the year, you have $98. So essentially what you're doing is you're paying the bank $2 to hold on to your money, because if you put it somewhere else, you're afraid you only have $80 next year, or $70, or worse yet, $0 at the end of the year. So think of a negative interest rate as kind of an insurance premium for a financial institution to hold your capital. All right, so how about some key considerations when forecasting in a negative or a zero interest rate environment? I'm going to go up here and shake my head and scratch my head and say something like, okay, negative or zero interest rate environment, this is probably not sustainable. So what do we do when we know that we're going to move out of the negative or zero interest rate environment? All right, so historical data may not be reliable for all the reasons that we have talked about. But also, I like this next one here, the next arrow point, which tells us that, of course, we have this zero interest rate environment or negative interest rate environment, but we might be doing some other things. Remember, the Fed, they control interest rates, but they also control the money supply. So we've had this concept of quantitative easing since the 2008 financial crisis. And so there might be other measures that might be adding or subtracting to the negative zero interest rate environment. So think about this. If what the Fed is doing is, if the Fed has a zero interest rate model and it is out in the credit markets, either buying or selling treasury securities or mortgage-backed securities or any other kind of securities that shows up on the Fed's balance sheet, well, then that might have a counter impact, or it might add to the impact of this. So, what is that second one? Effects of other monetary policy measures occurring at the same time. So look at both of these showing up in a fact pattern. All right, how about fiscal policy? So I said this earlier, right? What's the goal of a sound fiscal policy? To have a balanced budget so that the tax revenues equal the spending. What happens when that doesn't occur? I say to my students, when was the last time we had a balanced budget here in the United States? And they have a great answer. They say never. And I say, well, that sounds like the correct answer. But unfortunately, it's not. It is not accurate. And so you have to go back to, the last Bill Clinton year where we had a balanced budget. And so this is what the government does. They say something like, if we have a loose fiscal policy, if the government starts spending a lot of money, that means that us as individuals out there and businesses out there, if they have a supply of money coming from the government, that this will stimulate the economy. Now, how does the government do this? In its fiscal policy, it can decrease taxes or increase spending, which increases the budget deficit. Of course, the tight fiscal policy is just the opposite. Let's go ahead and relate the business cycle to the shape of the yield curve. I think I mentioned this a time or two just a little bit ago. So what do we know? The yield curve is nothing more than a picture of the relationship between the yield to maturity on the vertical axis and time to maturity on the horizontal axis. And almost always the yield curve is upward sloping for a variety of reasons. In a general sense, it's upward sloping because most people, most investors, most bondholders believe that the economy is going to expand. So that's a normal yield curve, which is an indicator. It's a leading economic indicator of an economic expansion. From a more technical standpoint, remember when we had our discussion back in level 1 about the components or the determinants of the yield, we start with a risk-free real rate of return, and then we add inflation, we add a maturity risk premium, we add a liquidity risk premium, we add a default risk premium. So when you add all those things, Each of them, some more than others, has an element of time to them. And so there's probably more risk associated with a long-term investment than a short-term investment. And so that reflects a normal upward sloping yield curve. Now, of course, the yield curve is primarily a function of two input factors: economic conditions, which is what I just described, and government actions. All right, so what happens? If we have a regular old normal upward sloping yield curve during times of an expected expansion, well, then what's going to happen is that curve is going to change depending on where the economy is during the business cycle. So the yield curve will become even more steep, it will become flat, or it will become inverted, depending on what's happening inside of the economy and what's happening with monetary and fiscal policy. All right, so let's look at that first bullet point there. The yield curve is probably super steep at the bottom of the cycle. It flattens during an expansion, so there we have those arrows there. Long-term rates fall, short-term rates increase. That means flattening. And it becomes flat or maybe inverted during a peak, and then it becomes downward sloping during a recession. Now, the reading has a section there in which the two governments, now when I say two governments, I don't mean two federal governments. So you think about it. You have monetary policy, so you have the central bank in charge, and you have fiscal policy, which is essentially Congress. So you have lawmakers and economists in charge of fiscal policy and monetary policy. So you would think that since they're part of the large federal umbrella, that they would work in lockstep. That if one is doing something that's stimulating, then the other one would do something that is stimulating. I mean, it doesn't make sense if they're doing the opposite, because they'll probably cancel each other out. All right, so what does this mean? For stimulative policies, the yield curve is steep and the economy is likely to grow. For restrictive policies, the curve is inverted and the economy is likely to shrink. All right, so that's when both policies are headed in the same direction. All right, but you ready for this? And this is probably what leads to a more interesting exam question. A restrictive monetary policy and a stimulative fiscal policy implies a flat yield curve, and the effects on the economy are unclear. However, a stimulative monetary policy and a restrictive fiscal policy probably means a steeper yield curve, moderately steep according to the reading. However, the effects on the economy are still unclear. So I would look at the difference between those flat yield curve and an upward sloping yield curve during the scenarios where Congress and the central bank are pursuing different policies. All right, let's go back to level 1, where we had a conversation about governments and how governments keep track of their debits and credits. So the current account, this is just net exports of goods and services, net investment income, and then unilateral transfers. That's probably not too big of a deal. So just remember exports and net investment income for the current account. I bet you remember that from level 1. The capital account is the investment flows, foreign direct investment, less purchases and sales of productive assets. Think of long-term assets there. So what's important in this summation of a current account and the capital account is this equation down at the bottom. So we have net exports. So think about what we're doing here. What we want to do is we want to say something like, what is the growth rate of our economy going to be? Well, what do we want? We want firms to find positive net present value projects. We want those firms then to have revenues on their income statement, right? P times Q, total revenues. We want our companies to sell lots of stuff inside of our borders, but we also want our companies to sell lots of stuff throughout the world, right? So if we're net exporters, so there's the X minus M, that probably has some impact on growth. Now, what is that a function of? It's a function of net private savings, right? Savings minus investment, and then the government surplus. All right, so here, just a summary of investments and tax revenues and government spending. So, look at the, here, let me go back here, that T minus G there, that's a result, a direct result of the fiscal policies. All right, so how do we keep this current and capital account in balance? In other words, we don't want to have these massive trade deficits, these massive capital inflow and outflow deficits. So how are they kept in balance? Changes in GDP, changes in the yield curve, right? Changes in interest rates, and that has an impact on asset prices. We talked about that a few slides ago, relative prices and then exchange rates. So we need to go ahead and have a conversation on the relationship between interest rates and exchange rates. And of course, they are super linked. I think the reading uses the word inextricably linked, whatever that word means. How about just super linked? But think about this. Let's suppose you have $100, US dollars, and you can go down to your bank and the banker pays you 10% interest rate. So you can turn that 100 into 110 by the end of the year. But suppose that you could just get in your car and drive to Canada and the Canadian banker is offering 50% interest rate. And let's suppose for some strange reason that there's a unitary relationship. 1 US dollar can buy 1 Canadian dollar. So what are you going to do? You're going to take your 100 US dollars, convert it to 100 Canadian dollars, go get your 50% interest rate. So you'll have 150 Canadian dollars at the end of the time period. And, are you ready for this? Here's the big kicker. If the exchange rate remains fixed over that time period, you'll turn your 150 Canadian dollars into 150 US dollars, and you'll have a 50% return versus a 10% return. All right, so this is probably not going to happen. Why? Why? Because the exchange rate is going to adjust because it knows that there are tons and tons of people in the United States that are going to provide US dollars in the foreign exchange market, therefore lowering the value of the US dollar, and then just the reverse is going to happen at the end. So that's why we have a forward market. The forward market is so extremely important to link interest rates and exchange rates. Didn't we learn that somewhere with interest rate parity? But what the reading does is it says, look at the second embedded bullet point, proposition that it is impossible for a country to pursue an independent monetary policy, allow unrestricted capital inflows, and maintain a fixed exchange rate. And the importance of this proposition right down at the bottom with that, that arrow down there, this is exactly what I was saying with my US dollar and my Canadian dollar example, right? So if the central bank pushes interest rates down, that means capital flows out, putting downward pressure on the exchange rate, and that means that the central bank is going to be forced to buy its own currency, which is an expansionary policy. All right. Now, what about a perfect capital mobility and a fixed exchange rate? So what does perfect capital mobility mean? It means something like, we can take our $100 and we are super mobile. We can go up to Canada without any restrictions. All right, so what if we have perfect capital mobility and a fixed exchange rate? Now, what we know is that we have these, super economies in which their currency is extremely valuable for transactions throughout the world. But then we have other developing countries, emerging markets, whose currencies are pegged to those larger countries or maybe some other countries. So they ought to have the same interest rate. So that's an important bullet point there. Countries whose currencies are pegged to each other should have the same interest rate given fixed exchange and given perfect capital mobility. All right, that makes sense. But what happens when the currencies are not pegged? There's going to be an interest rate differential, and that's going to be shown in the relationship between all of these different kinds of factors, especially if the currency is substantially overvalued and expected to decline. That probably means that yields in the bond market are going to be higher, and probably just the opposite too for significantly undervalued. So relative bond yields increase with strong economic activity, so increasing the demand for funds. So think about, the yield on U.S. government security and the yield on a Canadian government security. So those relative yields, the difference between those yields is probably going to have an impact on economic activity. And that takes us through this very long reading and this very long slide deck. So I'm going to go ahead and suggest that none of these are more important than the other. This really is a part of these capital market expectations. So think about what I was saying earlier on in the slide deck. What we're doing is we are essentially becoming macroeconomic experts. And we're going to use our macroeconomic expertise to be able to put together a better policy statement for our clients, because the more we know about the general economy, the more we know about inflation, the more we know about economic trends, the more we know about business cycles, the more we know about the shape of the yield curve, the more we know about monetary and fiscal policy, the better equipped, the better prepared we are, and the more effective we can use the tools at our disposal to craft a meaningful policy statement for our clients. So this is what I want you to do. I want you to go look at the reading, and I want you to look at those handful of questions at the end. What did I say earlier? The first 6 or 8, those are in the multiple choice framework, but then the next vignettes and question stems and fact patterns all have questions that say, let me go back here, explain this, discuss this, explain that. So we're right along these learning outcome statements. So thank you for watching, and good luck studying.